Thank you, Mr. Chairman. Good morning. I have a unique experience. I was heading the lending business of BB&T in 1980 and then CEO in 1990 when we went through other financial crises, which gives me kind of a different context. I am absolutely certain that the policies of the Federal Reserve, both the monetary policies and regulatory policies, were major contributors to the recent crisis. After the crisis, because the regulators have wanted to keep things tight, they've continued to stop venture capital lending. And that's kept growth from happening in the economy, and it's reduced competition, which has actually been a subsidy to big businesses. We've been subsidizing big business. It's a big mistake to believe that regulators know the proper level of risk. They had no idea what was going on before the financial crisis. They didn't predict. In fact, Bernanke said we weren't having a recession after the recession had already started. Today, they're doing exactly the opposite. They've tightened standards way too much, and it's hurting the normal growth rate in the economy. A sound capital position radically reduces the risk of bank failures. Very few banks fail with proper capital. Now, I strongly believe the capital position has to be understandable. It has to be a clear goal. It cannot be too complex, because I guarantee you the big banks will game the system. They do it every single time. In the kind of society we have, banks play a critical role of helping businesses get started, helping businesses change their model so they can grow. And we can't do that today. I can tell you it's harder to make a small business loan today than it's been in my 45-plus year career in banking. And that is not good for the economy, and it's not good for the consumer. Today, of course, I think that they have probably reduced the risk of banks failing, but at the expense of economic growth. And banks should be taking some risk, and a few banks should fail every once in a while. What we don't want is systematized risk, forcing everybody to the same standards, which is what a Basel does. And if banks were allowed to fail, which I would vote for, let banks fail, then the smart banks would survive. So banks care about liquidity. It's just because they have a leverage ratio isn't the only thing we were going to focus on. We didn't manage against regulatory standards. We managed for our own safety and soundness. We weren't fools. Bankers are human beings. We want our communities to do well. I enjoyed helping businesses get started, and we just can't do that anymore.
Mr. Allison?
That's correct, and markets regulate too.
Absolutely.
Markets, they discipline everything else in the economy, and we don't have massive wipeouts in the other segments of the economy. The one segment of the economy that had big problems is the one that's the most regulated. The subsidy that too big to fail creates for the large banks is going away out of this process. That's why they're uncomfortable with it, and why they'd rather have Basel and risk-based, because they have a much bigger chance of beating that system, focus on making government bureaucrats happy instead of investing in their business and in their customer base. We created a massive subsidy for big businesses. You can't start anything up, therefore if I'm in business, I don't have to invest because, hey, I got no new competitors. I was fortunate enough to help a lot of small businesses become bigger business. And it's not just startup. There's a moment where a business says, I'm going to have 2 locations or I'm going to have 100. And at that moment, you have to make a judgment call. You cannot do that in today's marketplace. The way the regulators have tightened lending standards that immediately make you charge that loan off, that require so much down payment that the guy couldn't do it. They've killed that market, and that market, even though only a small percentage of them get to be big business, that's a huge job creator and really important in terms of prosperity.